Hello, my dear friends. Myself is Rajesh Wadhwani. I have started YouTube channel Hari Seva IBBI Valuation Cracker. Today we are starting session 4 of income approach. In this session, we will learn investment decision, discount cash flow technique, two type technique, net present value and internal rate of return. Let us start. Discounted cash flow technique. Investment decision. Discounted cash flow technique, net present value and IRR we will learn uh, by calculating net present value and IRR we can take the investment decision. The discounted cash flow technique evaluate investment opportunity by analyzing future cash flow and their present value. In this approach, net present value is calculated by discounting expected cash inflow at a required rate of return and subtracting the initial investment. We will learn detail in next slide. If the NPA is positive, it indicates the investment is likely to yield more than the cost, making it acceptable. If NPA is zero or more than zero, then project should be acceptable because it will give to you positive cash flow. To determine the internal rate of return IRR, the discount rate the result in an NPA is zero is found. The rate represents the project return and useful for comparing against the required rate of return. Both of this method we will discuss in detail, and we will do here one example so that you can understand. In case study, also I will take 3 to 4 example in both the method. Let us first start net present value. Net present value is a key financial tool used to evaluate the profitability of investment project. It compares the present value of future cash inflow and outflow considering the time value of money. Valuation of real estate, already we have learned time value of money. Here, whenever you are doing any project, you are investing immediately, and return will come after 1 year, 2 year, 3 year, 4 years, slowly. So total how much return will come from the project, that first to be calculated, and that return to transfer present value, and total incoming return minus total project value, whatever result will come from that result will be taken investment decision. If result is positive, project can be run. If result is negative, then project is not acceptable. No one want to start the project. Okay, first key concept of NPV. Time value of money. A rupee today is worth more than a rupee in the future because it can be invested to earn return. आज रुपए का जो कीमत है 2 साल के बाद में उसी रुपए का कीमत कम हो जाएगा. We all learned in last valuation of real estate also. So first we are calculating time value of money. Okay. How to calculate it? Discounting future cash flow. Future cash flow are adjusted to their present value using a discount rate. Discount rate means required rate of return. This is when we are using in present value formula 1 plus R and this R is the discount rate. This R is called discount rate. Whatever value this is coming after solving this 1 divide by 1 plus R power n, this is called a discount factor. We will learn later. Positive NPA. The project is financially viable and should be accepted. If NPA is coming positive, project is accepted. Negative NPA, the project will lead to a loss and should be rejected. If result of NPA is coming negative, so then project should be rejected. Characteristic of NPA. Sensitivity to discount rate. NPA decrease as the discount rate increase. If R will increase, net present value will be decreased. Higher discount rate lower the present value of future cash flow. One number MCQ maybe came on this line. If an discount rate increase, what happened to NPA? If a discount rate is increased, NPA will be reduced. Time value of money. NPA take the time value of money into account, ensuring that the future cash flow are properly discounted to reflect their real value. Comprehensive evolution. NPA consider the entire cash flow stream, including both inflow and outflow. In NPA, we are calculating both. आप खर्चा कितना कर रहे हो, कमा कितना रहे हो, फिर उस खर्चे और कमाने को प्रेजेंट वैल्यू में ट्रांसफर किया जाता है. उसका प्रेजेंट क्या वैल्यू है उसको प्लस माइनस करके फिर एनपीए का डिसीजन लिया जाता है. देन एनपीए फार्मूला. एनपीए प्रेजेंट वैल्यू ऑफ फ्यूचर कैश फ्लो minus initial investment. This is the initial investment. Future value of future cash flow. NPA present value of cash flow. Okay, minus initial investment, same formula. Written second time. This means that NPA is calculated by determining the present value of all future cash inflow by discounting them to today value and then subtracting the initial cost of investment. If the result is positive, the investment is considered financial beneficial. Step to calculate NPA. How you will calculate NPA? These are the steps. Estimate net cash flow. First, you estimate the net cash flow. First year, you will get this much cash flow. Second year, this. Third year, fourth year, fifth year. First, identify the expected cash inflow and outflow for each period. How much you will expend on the project. That is the outflow. Then determine the discount rate. R value you have to decide it. In our MCQ and case study, R value will be given. After R value, calculate discount factor. This is a present value formula. 1 divide 1 plus R bracket close power n. You calculate this formula discount factor. This is called a discount factor formula because this is calculated for 1 rupees. If you multiply the cash flow amount, then present value will come. First calculate discount factor, compute present value, multiply future cash flow by their respective discount factor. Sum the present value, then do the sum. NPA equal to present value of future cash flow minus initial investment. Now we will do one example. At present, in case study, we will take separate examples. NPA, many times case study is coming 6 numbers or 8 numbers. A project with a lifespan of 3 years, cost of project is 1 lakh, generate revenue of rupee 30,000 in first year, 50,000 in second year, 60,000 in third year. If the discount rate is 9%, discount rate will be given in the question. What is the NPA of the project? You are doing total outflow is 1 lakh, total inflow is this much amount per first year 30,000, second year 50,000 will be calculated as per the present value, and third year 60,000 also calculated present value. All 4 figure outflow and 3 inflow on same platform on same date to be calculated. Say what data given? Initial investment 1 lakh, cash inflow first year 30,000, second year 50,000, third year 60,000. Discount factor 9%. Present value calculation. We know the formula how to calculate present value. This is a formula. PV is equal to 1 divide by inside the bracket 1 plus R, power of the bracket is n. To solving this type of question, make a table. 4 columns will be there in table. First years, second column cash flow, third column is discount factor. This discount factor is calculated by this formula. If 1, then n will come 1. If second year, n will come 2. If third year, n will come 3. Accordingly, it has been solved and we write here discount factor. This discount factor multiply by the cash flow, then all 3 figure will come in present value. Let us start. Initial you are done investment 1 lakh rupees. To take this year 0, you are done investment, and after that you are earning the money. But in big project, investment take 3 to 4 years. Then total outflow. First year you are done expenses 50 lakhs, next year 75 lakhs, then 100 lakhs and 200 lakhs. Then total outflow also be taken on same platform. Total outflow also calculated as per present value. But in our question here, total outflow 1 lakh, assume this outflow complete done in same year. So no discount factor. So outflow always take in the table minus side. क्योंकि this is money has gone. Minus 1 lakh into 1. Here discount factor is 1 and present value will be 1 lakh. First year you are earning 30,000. Discount factor will come 0.9174. You calculate with this formula 1 divided by 1.09 power 1. Then it will come this formula 0.9174 multiply 30,000. It will come 27,522. Then 50,000 discount factor second year with this formula will come 0.8417 and present value come this, and third year 60,000 discount factor will come this and present value this. You do not take in your practice directly discount factor from here. You calculate with your calculator. Also do the practice on the Excel sheet. Net present value example, a case study done in case study is fast. Then total expenses outflow minus 1 lakh, inflow 27,000, 42,000, 46,000. Total is positive 15,940. You can calculate by this formula also. You take all three inflow, total cost will come 1,15,940, outflow 1 lakh, uh, then equal to 15,940. The NPA of the project is 15,940, which is positive. This indicates the project exceeds the required rate of return 9% and financially viable. Therefore, the project should be accepted. Okay, this example is clear. Okay, now we start internal rate of return. Internal rate of return IRR is the discount rate that make the net present value of investment equal to zero. It represents the expected annual rate of return from a project or investment, accounting for the time value of money. IRR is the discount rate at which net present value of future cash flow minus initial investment become a zero. That discount rate will called IRR. Key concept of IRR. If IRR is greater than the required rate of return, the project is considered financially viable and should be accepted. If IRR is less than the required rate of return, the project should be rejected. Comparison with NPA. While net present value provides a rupee value of profitability, IRR gives the expected return percentage, making it easier to compare across different projects. In NPA, you will get the rupees value ki 50 lakhs profit, 40 lakhs profit, total cash inflow minus cash outflow. That will be the NPA. IR give the expected return percentage. It will give return percentage at 8%. Net present value is 0. Then 8% will be the rate of return. means you will get minimum 8% rate of return. If you are getting more rate of return, then it is also good. Project is financially benefited. Investment decision. The higher the IR, the more attractive the investment. However, it's important to compare the IR to the company required rate of return or cost of capital. Hope this is a clear IRR when net present value become a zero. That time whatever discount rate, that will be called IRR. So you know how to calculate net present value, you can calculate IRR. Calculation of IRR. IRR can be calculated by trial and error method or by linear interpolation. First, you calculate IR, you assume some discount rate. How much you discount rate you want, how much you rate of return want from the project. You are doing the investment. You want how much rate of return, 7%, 8%, 9%, 10%. That you decide and then see project is viable or not viable. To, to find the actual IR, the following linear interpolation formula is used. IR formula R1, this is rate of R1. Say you want 8%, that will become R1, and you take R2 for trial and error method, say 12%. Then you compare cash inflow and outflow, and you see with 8% it is coming positive, or with 12% is coming negative. Then both the amount linear interpolation, then you will find correct IRR, 9.2%, 9.55%. When we will do the example, you will understand easily. R1 plus, this is a bigger bracket, R2 minus R1. R is the rate of return, and that is the discount rate, into N1. N1 here net present value. Divide by N1 here minus N2. N2 figure will be also you will get in minus. So one you are calculating positive, one with other rate of return you are calculating negative. This minus minus become a plus. So both figure to be added. This is where I have explain you. Now we will do one example on IRR. Both the method, net present value and IRR, is a very simple method. Only one formula, net present value formula, that is called here discount factor. You first calculated discount factor and decided. Example on IRR. Ajit is considering investment of rupees 5 lakhs in a building hardware business. Okay, Ajit investing 5 lakhs. The cash inflow during first year, second year, third years, 1,50,000, 2,50,000, 3 lakhs respectively. The cost of capital is 10%. Data given. क्वेश्चन एकदम सिंपल है. अजीत 5 लाख का इन्वेस्टमेंट कर रहा है. उसको नेक्स्ट 3 इयर्स में 1,50,000 कैश इनफ्लो रहेगा फर्स्ट ईयर में. सेकंड ईयर में 2,50,000 रहेगा. थर्ड ईयर में 3 lakhs रहेगा. और आप डिस्काउंट रेट 10% and 15% assume कीजिए. So 10% he also want the cost of capital is 10%. First 10% assume कीजिए and 15%. Then you calculate net present value. You calculate net present value in table. If you are doing in Excel sheet, you will do fast question and mistake chances will be less. Make a 4 column, first column year, cash flow, discount factor and discount rate. We can write here present value also. Okay. First you assume 10% the discount rate. Okay. Here you write discount factor, present value, not only present value, every year present. Okay. First you have done investment of 5 lakhs, discount factor 1, and then this value, same term, same year present value is 5 lakhs. Now after 1 year you are earning 1,50,000. Then this 1,50,000 will be transferred present value. Then you use this present value formula 1 divided by 1 here 10% discount rate you write 0.10 into n here write 1 and solve this you will calculate you can find this answer 0.909. This discount factor multiply with the cash flow then you will get first year present value is 1,36,315. You are earning 2,50,000 on second year. Uh, Calculate discount factor 1 divide here and will become 2 with this formula value will come 0.826 and this is 2,06,500. Third year earning is a 3 lakhs. Then 3 lakhs transfer to present value. So then you calculate discount factor with this formula and will become 3 0.751 2,25,300. Total NPA is 68,150 minus 5 lakhs plus this directly here NPA will come 68,150. When discount rate is 10%, then NPA is coming 68,150. Now calculate present value with discount rate is 15%. First investment is 5 lakhs into 1 minus 5 lakhs. First year earning is 1,50,000. Here discount factor is 15%, R is 0.15 and is here for first year 1. Calculate this will come 0.870 1,30,500. Second year discount factor will come 0.756. Answer present value will come 1,89,000. Third year 3 lakhs 0.658 1,97,400. Then minus 5 lakhs plus 1,30,000 plus 1,89,000 plus 1,97,000. Answer will come minus 16,900. Now our uh, one figure came in positive with 10% discount rate and one figure came is negative with 15% discount rate. Now we have to calculate it IRR. That will be between 10% to 15%, and where net present value become a zero. So we will use linear interpolation pollution formula. This formula is this: R1 plus inside the bracket R2 minus R1 into net present value 1 divide by net present value 1 minus net present value 2. Here R1 is 10%, R2 is 15%, NPA1 is 68,150 as per this table calculation, and NPA2 is minus 16,900. 68,150 when discount rate is 10% minus 16,900 when discount rate was 15%. Now substitute the value in the formula and put this value, you will get IRR is 14.006%. Thus, the internal rate of return for the project is approximate 14.01. It is a more than the 10%, then project is beneficial. You can start the project. Income approach, all three methods we have learned. First, we have learned rental method with example. Second, we have learned unearned increased land price, and we have done profit method. Today we have learned net present value and IRR. These all five methods are very simple. Only practice is required. Please do the practice on all five methods. If you are having any doubt, I can solve in case study your question. Please send me your doubt question before 5th November 2024 so that I can take your doubt question in our case study session. Thanking you. Before leaving, please do not forget subscribe the Hari Seva IBBI Valuation Cracker channel. Hit the notification bell and like the channel, like the video. Thank you.